Happy Monday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Monday, January 13th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, how much more pain will global divergences cause? Our answers are, today starts a second consecutive week in which investors will be barraged by a litany of critical macro and policy data. On balance, we expect the data to support three divergence themes that have contributed to the recent poor performance across asset markets. Number one, U.S. exceptionalism on the growth front. Number two, sticky reported inflation relative to dovish forecasts among Wall Street economists and central banks. And number three, marginally hawkish Fed and BOJ policy versus marginally hawkish or marginally dovish ECB and PBOC policy. Those divergences have contributed to the hawkish repricing of the treasury market and, by extension, global fixed income markets. The 10-year nominal treasury reached the highest level since the fall of 2023 this morning. These divergences have contributed to U.S. dollar strength. The U.S. dollar index reached the highest level since the fall of 2022 this morning. What is different today relative to the fall of 2022 and the fall of 2023 is the positioning cycle is currently in an extreme bullish condition, meaning investors are betting on upside risk and risk assets to an asymmetric degree. Investor positioning was in an extreme bearish condition in the fall of 2022 and fall of 2023. What is also different about today than those periods is risk assets have not aggressively priced in the reduction in liquidity that these hawkish developments imply. Risk assets appear likely to catch down to where the multi-month downtrend in the 42 macro global liquidity proxy suggests it should be. Transitioning to our 42 macro or dashboard here, as always, a wrap up with a question from our community. This one's regarding the 10-2 Treasury yield spread. It says, hi, Darius. The spread was inverted for about 2 years before rising slightly above the zero line for a few months, and then started a more decisive rise around mid-December 2024, and is now 38 basis points above the zero line. Historically, that behavior has foretold recessions, but I believe the economic indicators are pointing to slower growth, not a recession. That is correct. What is your interpretation of the 10-2 spread? Unlike the run-up to prior recessions, the 2-year yield is trading sideways rather than decisively trending down. It would appear the 2-year recognizes the resiliency of the economy and that the Fed is not looking to aggressively cut rates. That is also correct. Is it possible that the 10-year yield is the main driver of the yield curve spread because it is anticipating higher inflation ahead? So excellent question, very well contextualized. And so a lot of the assumptions in the question were correct, in my opinion, with respect to the 10-year yield being the main driver of this. So right now we are in a bearish steepening of the yield curve. That just means that bonds are going down as the yield curve steepens, or the security prices are going down as the yield curve steepens. And this is, as the question implies, a function of the reduction in policy rate easing that was priced out of the forward rate curve in recent months. So that is certainly a big driver. And the fact that it is being the 10-year is rising does not necessarily mean it's a sign of higher inflation ahead. It could be a sign of higher inflation ahead. It could be a sign of higher rising nominal growth expectations. It could also be a sign of rising term premia, of which term premia have accounted for about 80+% of the rise in 10-year treasury yields off the cyclical low that we observed back in early to mid-September prior to the Fed's starting to cut the policy rate. So this big driver, this big expansion of term premia, which by the way is still well shy of its historical mean, it's got quite a ways to go in that regard. If we were going to get back to those historical means anytime soon, this big expansion of term premia, in our opinion, is being driven by fiscal policy concerns with respect to the likely widening of U.S. Budget deficits relative to the baseline over the long term. Now, again, Doge is going to find avenues to pockets of federal expenditures to cut, in order to sort of balance, to offset some of the revenue reduction that we're going to see as a function of extending and expanding the Trump tax cuts. There's also going to be tariffs as a revenue raiser to offset some of that stuff as well, because don't forget, if you're going to use reconciliation to change fiscal policy, the changes cannot have an impact on the deficit on a 10-year forward period. That's part of the Byrd rule up in the Senate. So they're going to have to find expenditure reductions and revenue raisers, in my opinion, in the form of tariffs to kind of to offset that. But the key takeaway is that relative to the current baseline of current law, this stuff is going to wind up with a deficit expansion, given that, again, current law has the Trump tax cuts expiring at the end of 2025. So just extending them is going to add trillions of dollars of incremental debt to the U.S. Public sector balance sheet over the course of the next 10 years. So again, they're going to have to find avenues to offset that from a Byrd rule accounting perspective. So, but again, in our opinion, this is why the term premium have won so much recently, because we were starting to see the whites of the eyes on some of these sort of fiscally expansionary policies that we are likely to get in the coming months, if not quarters. So we'll wrap it up there. Darius Dale presenting our macro minute for Monday, January 13th, 2025. Everyone have a wonderful day out there. Best of luck, and we'll catch you back here tomorrow. Cheers.